Hello, everyone, and welcome to Momentum Channel. My name is Mo, and in this video, we're going to be talking about two undervalued dividend stocks with a dividend yield of over 5% for investors to watch or buy right now in the stock market. Let's get into it. Our very first pick is one in the communication sector, and it is no other than Verizon, currently with a dividend yield of 5.03%. And showing a market cap of $216 billion, making it a mega cap size business. The dividend for Verizon is currently has a safety score of 87, making it a very safe dividend at this time. From a volatility perspective, Verizon has a beta of 0.29. Beta is a measure of stock's volatility, and beta of less than 1 suggests that the stock is less volatile than the overall stock market. Verizon was formed in 2000 when telecom giants Bell Atlantic and GTE merged in a $52 billion transactions. Its key to success has been delivering reliable wireless and wireless services over the best communication networks in the country, and the company invests more than $15 billion annually to increase its capacity and reliability of wireless networks. Thanks to these massive investments in capital equipment and the spectrum licenses, Verizon typically delivers industry-leading wireless reliability, speed, and network performance. Overall, Verizon seems likely to remain a reliable income stock for dividend investors. Looking at a number of additional pieces of information and key metrics, the payout ratio for Verizon's dividends at this time is at 47%, which is considered very low for telecoms, giving it a ton of room to continue to grow and increase its dividend for years to come. Even its forward payout ratio has it's at a similar rate and amount of 47%. Verizon did continue to pay and increase its dividend, in fact, during the recession years of 2007-2009, which is remarkable. If you look at the dividend history for Verizon, they have been paying their dividends without any reduction for the past 31 years, of the past 15 years of which they have increased it year after year. Currently, Verizon pays its dividend quarterly, and it's paid in the months of February, May, August, and November, with an annual payout of $2.56 per share. Looking at the timeliness of buying or adding this stock to your portfolio, Verizon currently, with its dividend yield of 5%, is showing that it is about 13% above its own 5-year average, and a lower than usual forward price to earnings ratio, which is only showing at 9.4 forward price to earnings ratio, compared to that of communication sector at 16.6. These all point out to the stock being undervalued, and it could be a decent time to invest if you believe the company's long-term outlook has remained the same. Looking at the price range in the past 1 year, the last price of $50.94 per share is hovering in between its 52-week low price of $46.23 and its 52-week high price of $57.34, though slightly closer to its 1-year low price. If we look at a number of additional financial metrics, such as earnings per share, ideally for earnings per share, you'd like to see this number growing year after year steadily. It does not happen all the time for many companies. And in this case, we have a little bit of that drops at years, for example, 2016 and 17, the earnings per share went down, but it's almost as if it goes through some step growth over years. For example, in 2021, the company was showing $5.39 earnings per share. And for the next 12 months, it's estimated to show $5.44. As for number of outstanding shares, ideally, we'd like to for this number to continue to decline. That said, for the Verizon, over the past about 6 to 7 years, they've fairly stayed stagnant. And in the last 12 months, they're showing about 4.17 billion outstanding shares. Total sales, ideally, we'd like to see it gradual, continuous increase. In the last 12 months, the business is showing $134 billion in revenue and total sales, which is one of the highest that they've had on record in the past 10 years. Lastly, in terms of return on equity, which measures how many dollars of profit a company earns for every dollar shareholders have invested in the firm, it's ideal for telecoms to be above 11%. And we're noticing that in all of the past 10 years, they've met and exceeded that threshold. In the last 12 months, they're showing 28%. Next, we're going to move on and look at the past stock price performance of Verizon. In the past 1 year, stock of Verizon was down by about 11.16%. However, in the past 5 years, it is showing to be up by close to 9%. This does not take into account the dividend income that you've been collecting. As for the stock price and its price projection and coverage by analysts, the price target by analysts on tip ranks, there are 8 of them covering the stock, with 2 of them having a buy rating, 5 of them having a hold rating, and 1 having a sell rating, giving the stock overall hold. The 1 year price target is at $54, and that shows an upside of close to 6%. However, analysts on Yahoo Finance are a little bit more optimistic about the stock, giving it a 1 year price target of $58.61. As for the fair price valuation, according to Simply Wall Street, the fair value for this stock is at $174.79. And if, according to their calculation, this shows the stock is undervalued by about 71%. Before we move on and take a look at the second undervalued stock with a dividend yield of over 5%, I have a big favor to ask you. I've put a ton of time and effort to put this video together. I really appreciate if you can smash that like button and subscribe to our channel for more videos. All right, our second company to review with its high dividend is Main Street Capital. It's an asset management and custody bank in the financial sector with a dividend yield of 6.87%, close to 7% dividend. It has a dividend safety score of 62, making it another safe dividend payer, and it has market cap of $2.77 billion, making it a mid-cap sized business. Founded in Texas during the mid-1990s, Main Street Capital is a business development company, BDC. BDCs primarily provide debt and equity capitals to relatively small, highly leveraged companies that cannot access traditional financing from banks. Overall, Main Street is one of the few BDCs for its conservative income investors to consider. Given the nature of their effort and services, though, they can be a little bit more riskier. The firm, that being said, as we indicated, is not immune from the industry's challenges, but they're with them being one of the best positioned BDCs to maintain its dividend in good times and bad times. It could be a considerable option for investors to have as part of their watch list or even add to their portfolio. The payout ratio here is at 90%, although it may sound quite high. It is relatively low for BDCs based on their nature of industry. We also wanted to point out for you that if you look at their performance during the recession of 2007-2009, during those years they maintained their dividend, although they did not increase it. At least they did not cut it either, and their sales or revenue were down by about 7.5%, which is definitely above average and better than the overall S&P 500. As for the stock return during the recession of 2007-2009, the stock was down by 25%, which definitely was better than the S&P 500's negative 55%. Main Street has been paying its dividend uninterrupted for the past 14 years, and in the last 11 years of those, they have increased it year after year. Currently, the stock has an annual payout of $2.58 per share, and it does pay its payments and dividends on a monthly basis. Looking at the timeliness of buying or adding these shares to your portfolio, with a dividend yield that is currently 14% above its 5-year average, as well as a lower than usual forward price to earnings ratio of only 12.8 compared to its own 5-year average, the stock appears to be undervalued at this time. It's also worth mentioning that the last trading price of $37.57 at the time I'm making this video is a lot closer to its 52-week low price of $35.96, which might be quite ideal to take advantage of this exceptionally nice dividend yield of 6.87% at this time. Their 5-year average for dividend overall for this business is also above 6% at 6.03% to be exact. Earnings per share for the stock in the last 12 months was at $2.79, and it's projected to be at $2.94 for the next 12 months. definitely the highest amount projected in the past 10 years. Outstanding shares, it appears to be growing year after year and not ideal, but due to the high payout ratio for BDCs, it is generally common for them to have to borrow money and issue shares to grow their business. So it is important as we are looking into this metric to keep that concept in mind and not forget about that contextual information. As for the total sales, this business is being nicely growing its revenue, and in the last 12 months, it's reported $306 million in total sales. Lastly, in terms of return on equity, ideal for BDCs to have above 10% of return on equity, and except for the year of 2019 and 2020, in the past 10 years, in all of the other years, they have surpassed that threshold, with the last 12 months showing 20% return on equity. Let us look at the past stock return. 1 year return of the stock is down by close to 9.7%, and in the past 5 years, the stock is down by close to 3.6%. Again, this does not take into account your dividends that you've gathered and collect from this stock. As for analysts covering the stock on tip ranks, there are two of them, one with a buy rating and one with a hold, giving the stock a moderate buy, with an average stock price target of $43 in 1 year, suggesting an upside of 14.45%. Analysts on Yahoo Finance is slightly less bullish, with a 1 year target of $42.40. All right. As for analysts on Simply Wall Street, they give the stock a fair valuation of $39.38 at this time, suggesting the stock is undervalued by about 4.6%. Well, there you have it, folks. A quick look into two undervalued dividend stocks with dividends over 5%, one of them close to even 7%, for dividend investors to consider to watch or potentially add to their portfolio upon their research and additional analysis. Hope you found this video beneficial and gained something of value from it. If you did, please don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in the dividend stock, growth stocks, as well as penny stocks. We also talk about ways to reach financial freedom. Thank you, and I hope to see you next time.